All right, so we're jumping in. Thank you for taking just a few minutes out of your day. This is, as you know, Life Insurance Awareness Month. So I hope you're reviewing your policy. You've probably heard me all month long kind of harp on this because it is one of the most important documents that you own, but it is probably the most overlooked at the same time. We stick it in a drawer and all it does is collect dust until the day we need it. And that day, it becomes the most important document, most important decision you ever made. Well, today's topic is children. Okay. Think of the children, right? What about the children? So there's three ways that you can cover a child that I know of. Number one, you can add them as a rider to your policy. That's probably the cheapest way, and it probably is with the least amount of benefits. That's because it's the cheapest, right? You always get what you pay for. The second one, and we're not even going to talk about that one because that's super simple. You just add them, they're part of your policy. When they turn 18, they can sign off and become the owner of the policy and so forth. But if you were to set them up as their own life insurance, okay, it's about the same price, by the way, as a rider. I don't know if there's really much different except that they have their own coverage, and instead of being attached to you, cancel yours, theirs goes away versus having them separate. But if they get their own policy, typically just a child's policy, this is through Foresters Financial. Great company, by the way. I work a lot with Foresters. So I'm going to share my screen a little bit bigger so you can see some of these numbers. If I were to get a $50,000 face value policy, pay to 100, which is the normal regular whole life. You can pay quicker. They do a 10 pay. I think there's a 20 pay, but pay to 100 is normal for whole life. It's $22.99 a month. So $22.99. Okay. And you're going to be paying on that sucker. Well, this is a 5-year-old. For a 5-year-old male, you're going to be paying on that for 95 years. Okay. But you'll also build cash value. And if you scroll down, you're going to see that the cash value by the time they reach 95 is 45. It's going to be right around a little shy of $45,000, so maybe 43, whatever, right? Cash value. And then a reduced paid up amount if you decide you want to just reduce pay up that sucker, which means I want to stop paying into it and keep that death benefit the rest of my life. That starts here. That's the 50,000. You'll see. So, anyways, very basic policy. You can see that that's level. When we're talking about a regular whole life policy, they're almost always level, which means that death benefit never goes up. You see, it's $50,000, always 50,000, 50,000, 50,000. Okay. So if you did there's a couple of different options here for pay to 100, pay to 10. This is a very simple, very basic. It's 12 or 20. What is it? 22. We decided, yeah, $22 a month for children's policy. 50,000. They pass away, you get $50,000 for funeral or whatever you need. All right, that's option one. However, as stated in my subject line, what if we did a difference of $11.62? Where does that come from? Well, I ran an illustration on a participating whole life. And if you can look at this with me, we're going to see the difference here. For those of you that can't see my screen, you're just going to listen to me spout off some numbers, and then I'll share the video if you want to actually look at the illustrations. But here we go. You can see a participating whole life actually builds with what's called paid up additions. And what that means is when the company issues a dividend check, it goes into your policy, it buys a small amount of death benefit, and it grows your cash value. So you can see here over the guarantees, going to be similar to that other one that we got. Only if you're paying $34.61, which is $11 more per month, $11.62, I think, you're going to be getting cash value growth with those dividends over the years. And if you're starting them out at 5 years old, same illustration, what does that do when you have time on your side? Okay, that first of all, the death benefit does not stay at 50. You can see it's growing. Okay, so that's the first thing that you're going to get over the years until their age. Well, let's go forward all the way to age 100, just like the other one. We had 50,000 when they were age 100. Here, if they go all the way to 100, they've got $202,000 of death benefit. Huge difference, right? Most people, life expectancy is going to be in the 80s, right? So you start a kid young, $30 a month. Okay. By the time they're hit life expectancy, they have a policy, $100,000, $200,000, okay, with the dividend growth over the years, and they've still only been paying that $30 a month, $34.61. So you're setting them up for a policy that by the time they're in their 50s and 60s, I write these policies all the time for people. They're going to be paying $300 or $400 a month for a whole life policy at that age. Whereas your kid will thank you every day when they're making that premium payment of $34. And that policy now has grown so much that that compound interest is kicking in so much that now they're growing their cash value. You can see way back here in the early years, cash values are growing about $1,000 a year, $1,000 a year. Then right here, it starts getting up to like $2,000 a year. See that? By the time they're getting their 80s, it's jumping up $4,000 a year. So by the time you get to life expectancy, okay, you have almost as much cash value as you do in your death benefit. So if you were to cancel that policy out, that cash value check is what they're writing back to you. So you could feasibly set this up, cancel it in when you're 85 years old and get a check back for $124,000. Well, let's do some calculations really quick. 34.61 times 12. So that's 415.32, yep, per year. And this is, let's go to age 80. So, or age 85. So that's 80 years. So times 80 years. So you've paid in $33,000 on that policy. And look at what you've got. You've got an asset, a cash asset of $124,000 that they would pay back to you if you canceled, or that you can borrow from. And you've got a death benefit if you pass away of $154,000, rather than what we were looking at before, a flat rate of $50,000 with a very meager cash value growth over the years. Why? Because it's just level. It's not participating, and it doesn't have the paid up additions, and it's a different type of policy. Now, there's one more reason why this policy is superior to the other one. This policy actually includes living benefits. Let me show you that. Chronic, critical, and terminal illness. Should this person, your child, have a heart attack anywhere along the way, any kind of a stroke, it's all in here, cancer, ALS, organ failure, Alzheimer's, there's a whole list. Let me see if I can find it in here. Yeah, here's a list all right here. End-stage renal failure, terminal illness, chronic illness, which is long-term after 90 days. You get a major disability, right? So this policy will cover that, in that they can submit a claim. Your child, who started at 5 in their 60s, has a heart attack, which happens a lot, and they can get money from their death benefit. They can get a payout from a living benefit rider. It's called an accelerated death benefit rider, which means, I'm sorry, not a living benefit rider. It's a death benefit rider, but we nickname it living benefits because it's the benefit for you if you don't die. You get sick and you don't die. So this policy protects against death. It protects against just having a cash asset if you need to borrow from it, but it also protects you if you get sick. So it's pretty darn comprehensive. And this one, of course, doesn't have that. So difference between the two, I don't know if you agree with me or not, but for $11.62 more, kind of lean in that direction. You see what I'm saying? Anyways, I hope this is helpful. Thank you for listening. Thank you for bearing with me and learning all this cool stuff for Life Insurance Awareness Month. If you know your policy or your agent, reach out to them and have them do a coverage review. If you don't, or if you want me to, for whatever reason, you think that I can handle that for you, I would be honored. Reach out to me. We'll take a look at your coverage. We'll look at these options and more. A lot of different ways you can use life insurance that a lot of people don't realize. So thanks for listening. I hope this has been helpful, and I'll see you, I'm sure, another time.